Hey, everybody. Welcome. Thank you very much for joining. For the first time, I'm going to finally take a look at historical interest rates. We're going to look at how the Federal Reserve set interest rates before, during, and after the Great Depression. All right. So over the past week, a little bit more, we've come to know this picture, I think, quite well. This is the weekly balance sheet of the Federal Reserve. Again, you're not wrong to call the entire balance sheet money printing, central bank money. Although if you want to be very precise, as we've done before, you should look at the liability section of the central bank's balance sheet. There you'll find the monetary base, notes, bank reserves, so on and so forth. Nonetheless, today we're just going to stick with the total assets of the Federal Reserve, the total balance sheet. Also, as I mentioned, now for the first time, I'm going to show you interest rates. What does the central bank of any nation do? This is the main policy rate of the Central Bank of the United States. They were not the first central bank to do this. That would be the Bank of England, which really kind of modernized central banking, even though the Swedish central bank was technically the first central bank a little bit before the Bank of England. Federal Reserve was founded in 1913, opened their doors in 1914. Over the early part of the Federal Reserve's lifetime, they influenced the markets most through what is called the discount rate. Eventually, they started tracking and targeting what's called the federal funds rate. We're not going to get into that in this video. Just generally, though, something to say about interest rates. You can see here, they're a low just at the end of World War II, 0.5%. Here, in 1980, you can see the discount rate is 14%. And then the federal funds rate kind of takes over as the main policy rate. And after the global financial crisis, we're again down to 0%. They actually established a range at this point. You see upper and lower federal funds target rate of 0 to 0.25%. That's gone up, that's gone back down. Now it's going up again. I think we can all imagine where it's going to go in the future if there's too much pain for banks. You know, in recent years, the last 15 years, is back down to 0%. So 0.5% up to 15% or so, just under 15% to 0% again in modern, very, very recent modern times. I can tell you, dear viewer, dear listener, if you follow Sidney Homer's The History of Interest Rates, where he tracks interest rates over 5,000 years, these are extremes. Okay, interest rates have never been this low. They have never been this high, specifically when a central bank has set them, but just in general, permeating throughout the economy. Of course, you can always have loan shark rates and whatnot, but if you're talking about main banking rates throughout the main banking system, you'd have to go back to ancient Mesopotamia, ancient Sumer, ancient Greece to find rates close to 20%, and you've never found them at near 0 or 0% ever. So what is the interest rate? One more thing, I guess, broad to talk about. Is the interest rate the price of money? Right? The central bank deals with money. They print money. So is the interest rate the price of money? Contrary to what you have probably heard from many economists over the years who misstate this all the time, the interest rate simply is not the price of money. Does it have something to do with money? Absolutely. Especially fiat money, which the central bank controls. And as I mentioned, the central bank also controls short-term interest rates specifically. Although you can make an argument that they control longer-term rates as well, specifically as they become more involved in the banking system. Nonetheless, they say they only control short-term interest rates. So is the interest rate the price of money? Absolutely not. If you've heard an economist say that, they're either not thinking clearly, or they're just making stuff up, or they're not really, perhaps don't really know what they're talking about. The price of money. What is the price of money? Is it the interest rate? Of course not. The price of money is the exchange rate. The exchange rate. So what's the price of the dollar? Is it the short-term Fed funds rate? Is it the 10-year Treasury note rate? No, of course, the price of the dollar is ordinal. You have to look at something else at any given time. So compare the dollar to the euro, compare the dollar to the yen, compare the dollar to the Chinese yuan, the Russian ruble. That's the price of the dollar. The exchange rate. That is the price of money. What's the price of Bitcoin? Is the price of Bitcoin some interest rate? No, the price of Bitcoin is the price of Bitcoin. What's the price of gold? Notice that when we get away from the world of fiat, things become more clear. So, of course, the price of gold is the price of gold in dollars or euros or yen. Same with Bitcoin. The price of Bitcoin is the price of Bitcoin in dollars or euros or yen. In other words, the exchange rate. So anytime you hear an economist tell you that the price of money is the interest rate, they are dead wrong. So if the interest rate is not the price of money, what is it? It's the price of credit. Generally speaking, it's the price of credit. You can also say it's the price of time. In fact, I was just perusing a great book, relatively recent book. It's called The Real Story of Interest by Edward Chancellor. That's the subtitle. The title is The Price of Time. I highly recommend this book. Really great history of interest. And indeed, that's what it is. An economist has described the interest rate as the price of time or the price of credit. That's what it is. So we've seen that a central bank managing the interest rate, which if you followed this channel for any given amount of time, you know that I don't think that's a good idea. When the central bank, when a monopolistic actor steps in and sets the rate for credit in the market, that's typically going to be a problem. This is something that an economics school called the Austrian School, which I'm a big fan of, has always said. By the way, this book that I just referenced, Edward Chancellor, that's generally the conclusion that he holds. He gives a lot of credit to the Austrians in their early theories. And we're going to talk a little bit more about that here. So I want to focus on, as I mentioned in the intro, the Great Depression. We'll get to all this in future videos here, but right now I just want to focus on the Great Depression. Okay, so let's zoom in to say here. All right. Federal Reserve, they opened their doors in November of 1914. So you can see that the discount rate at the very beginning was 5.5%. Now, the discount rate. Why the discount rate? Why was it called that? Well, that actually, traditionally, the discount rate, you've probably heard this. I'll explain what it is in Federal Reserve parlance or in central bank parlance. But it has nothing to do with the central bank originally. Everybody knows the interest rate, basically, or at least they should know the interest rate. It's an annual percentage return that the lender will receive and you have to pay effectively for borrowing money. You can have annuities, you can have interest-only loans, you can have many different ways to pay interest, credit card loans, so on and so forth. It's an annual percentage yield, okay, compound annual growth. This is just for your information. The discount rate has to do with Florentine times, the Renaissance, even before that. The invention of paper money, by the way, contrary to popular opinion, it did not happen with the Medicis or in the Renaissance. It actually happened in two places. The invention of the check happened in Iraq, what is present-day Iraq, in the Muslim world, about 1,000 years ago. And even more than 1,000 years ago, 1,200 years ago, 1,300 years ago, what have come to be called bills of exchange or even checks, that was invented in China. So what does that mean, a discount? Well, basically, that was kind of the original way to charge interest with paper money, because paper money had a face value. But then if you were going to try to transact with paper money throughout many different parties and you're at the end of the line, you're a bank, you want to decide if you're going to give this person that gives you this paper, you're going to give them, let's say they want 100 grams of gold, or 100 grams is a bit too much, 100 grains of gold, how about? For 1 unit of this paper money. Is the bank going to give them exactly 100 grains of gold, or are they going to give them something else? Typically, they're going to give them something else, and that is a discount. So the discount is a very, very old term in banking. It precisely has to do with checks, bills of exchange, and banknotes that bankers, at the end of the day, are going to apply to paper that is presented to them. They are applied a discount. And you can actually factor in an annual percentage rate of interest, of course, from that. So that's the discount rate. That's what it actually means historically. Nonetheless, here with the Federal Reserve, they have also used this term since the beginning. The Bank of England has used a term called bank rate, although I believe that they used the term discount rate early on. The discount rate. Basically what this is the lender of last resort rate. But it didn't even mean that in the early years. In now, let's say from the 40s on to now, and now they even have a different definition of the discount rate from 2003. Also, the federal funds rate has overtaken, but the federal funds rate is actually what banks lend to each other. That's what banks lend to each other. The federal funds rate, which is what the Federal Reserve targets. The discount rate, this is the emergency rate, the lender of last resort rate. But here Here, in the early days of the Fed, specifically up until the Great Depression, the discount rate was the primary means of the Federal Reserve lending money into the economy. They would lend money into the economy with the discount rate. So banks could borrow from the Federal Reserve using this rate. It wasn't even necessarily a lender of last resort rate. The Federal Reserve was kind of like another bank. Not all banks were members of the Federal Reserve at this time. And this is actually the primary means how the Federal Reserve printed money ex nihilo and lent it into the economy. It was via this discount rate mechanism, or what's also called the discount window. So you see here, Federal Reserve's balance sheet was, a couple $100 million, quickly goes to $1 billion when the U.S. enters World War I. There is no open market operations here at this point. But this is primarily before the Great Depression. Banks borrowed from the Federal Reserve using the discount window. So since the Great Depression, this has come to be known as the emergency or sort of lender of last resort rate. The Federal Reserve has kind of discouraged lending at the discount window. But nonetheless, here, this is kind of like the Federal Reserve printing money ex nihilo and just lending money to the banking system at this discount rate. So that's how they did it in the early days. That's how they lent Federal Reserve notes and deposits into the system. And indeed, notes were a very small proportion here of the balance sheet. It took a while to actually gain traction, gain steam. Most of the time, it was ledger-based money or bank reserves that they were lending into the economy at the discount rate. So that is what the discount rate has been historically. Now it is true that it is kind of the lender of last resort rate, the emergency rate. We'll talk more about that in future videos. But I just want to focus on the Great Depression, as I've mentioned. Okay. You see here that the discount rate was 4%. And then once the money printing really started when the U.S. entered World War I, of course, they were buying war bonds as well. This discount rate, they had to raise it. In fact, and it's interesting because right about this time, the end of the teens, the early 20s, this coincided. Benjamin Strong was the head of the Federal Reserve, very famous. This was precisely at the time where the theory of interest and the theory of prices started to merge. Okay, so Knut Wicksell, he was a famous Swedish economist who talked a lot about this. He thought that the theory of interest, or the natural rate of interest, could be reflected in prices. This has come to dominate the lexicon today. In fact, we use the word inflation to mean price inflation, when in the past, as the Austrians have always pointed out, it means monetary inflation. So again, those that have followed this video, you know that I'm not a fan of central actors in the economy pushing markets around. That's precisely what the Federal Reserve has done. And the Austrians have always been very, very vocal critics of sort of scientifically finding the right interest rate and then matching that to the right price rate, or in central bank speak, providing the right amount of monetary elasticity to the economy to provide the right amount of price stability to the economy. The Austrians kind of always viewed this as voodoo, and I very much agree. In fact, the book that I mentioned earlier, Edward Chancellor, here is an Austrian who is talking about the idea of a price level or a consumer price index all the way back in the early 1900s. The idea that as complex a phenomenon as the change in a, quote, price level, itself a heroic theoretical abstraction, could at present be measured to such a degree of accuracy is nevertheless simply absurd. I wholeheartedly agree with this quote. Prices, as defined by a government agency, are basically free lunches. There is no real skin in the game of setting a price level. Of course, it can vastly, drastically affect your purchasing power, particularly when the Federal Reserve or other government agencies measure the price level and then Social Security checks are adjusted to that price level. It's absolutely monumentally consequential. But the actual nature of describing what any level of prices is at any given time, of course, is absurd. We can't do it. Maybe an index of stock prices works because there's actually skin in the game, but there's no skin in the game for government agencies setting a price level. This is what the Austrians have always believed. I wholeheartedly agree with this statement. So another point that, again, is important here when we're talking about the Federal Reserve, Benjamin Strong, who is another character that came in here, Irving Fisher. Irving Fisher was well known about 9 days before this happened as saying stocks have reached a permanently high plateau. This is Irving Fisher, economist, investor at that time. He lost a lot of credibility, to say the least, after saying that. Yet nonetheless, we still follow his policies. But here's another interesting thing about Fisher you might not have known. Around this time, 1921, he founded what was called the Stable Money League. This later was called the Stable Money Association. This is the earliest beginnings of influencers, economists, and bureaucrats working together to kind of achieve this voodoo science of managing interest rates together with managing prices. So unlike, as the Austrians said, all of this stuff should be done freely in the market by supply and demand, no, money is such an important thing. We need to control it. We need to control the issuance of money. And of course, indirectly, we need to control the interest rate, which is the price of credit. So you see here, the Federal Reserve's balance sheet, has exploded from under $1 billion. And then after World War I, specifically the United States' entrance into World War I, by 1920, it is $6.4 billion. And presumably prices are going a little bit high here. They were. That they had to choke off price inflation by raising the discount rate to 7%. And what happened here? Tom Woods, of course, made this depression famous. This was the Depression of 1920, 1921. This was actually worse than the first year of the Great Depression. And of course, how did they solve this? As they do typically, they lower the interest rate. After they have caused the bubble with low interest rates, money printing gets too hot. They try to choke it off. They try to raise interest rates, and then that causes the bust. So look at the boom before the bust, as Hayek says, and then they're trying to correct here. So right around this time, amazingly, as Irving Fisher is trying to gain steam and gain academic credence with the Federal Reserve, saying we should really focus on stable prices, and Benjamin Strong all the way along is agreeing with him, the chairman of the Federal Reserve. This is what's happening. There was a depression. Again, they claim that they can solve the depression that they caused by artificially low interest rates. And again, banks in large numbers were coming to the discount window for the Federal Reserve. They were in large numbers coming to borrow from the Federal Reserve at presumably a cheaper rate than they could get in the market. I will show you corporate paper. Again, interest rates are a little bit weirder, a little bit different at this time than now, a little bit harder to get access to. I will show you some market interest rates. Obviously, you see how these moves in straight lines, right? This is not market. These are targets that the Federal Reserve has set. Okay, this is the main policy rate. This is the discount rate or the discount window. So what happened here during the 20s? Well, as Mark Thornton from the Mises Institute has pointed out, the skyscraper index, this is taking off at this point. More skyscrapers are being built in Manhattan during the Roaring 20s than had ever been before. Of course, it was a record. The density of Manhattan was exploding at this time during the 1920s. And what happened? Well, the discount rate was quite high, 7%. And again, see back my video on the sensitivity of bonds, of any debt, really basically based on the yield or the interest rate. Just a quarter point, half point can change your eligibility to borrow or not borrow tremendously. And when interest rates fall, it's very good for you to borrow. So the discount rate was 7% here when the Depression of 1920 and 21 was going on. Federal Reserve drops it, raises it a little bit, drops it again. To this point, mid-1920s, we're at 3%. Only a few years prior, we were more than double. Now we're 3%. And you can see the balance sheet doesn't change too much. I'll talk a little bit more about that in the future. It doesn't always mean that a low interest rate will immediately cause the balance sheet to explode, as you do see today. It doesn't always mean that. There can be components of the balance sheet which change inside of that. We'll talk about that in the future. But nonetheless, this is what they set. Okay, the market doesn't set this rate. The monopolistic actor of the Federal Reserve sets this rate. Okay, so they have set this at a very, very low rate here, 3%. Roaring 20s are continuing on. Irving Fisher is convinced that prices can be scientifically managed by the central bank and the government. But all of a sudden, you see the Federal Reserve is probably worried about what has happened here. Stocks are starting to explode. Real estate values are exploding. Prices are exploding. We're going to need to choke that off a little bit. We're going to need to choke off the availability of credit with the main policy tool that we have, which is the discount window or the discount rate. They pull it up. They're pulling it up now from a low of 3% in the mid-1920s. We're at 4.5%, 5%. Going to the eve of the Great Depression, the collapse of October 1929, what is the discount rate? 6%. So actually a little bit lower than it was in the 1920-21 Depression, but still as high as it has ever been in the entire history of the Federal Reserve. 6%, except for this, of course, in 1920-21, 6%. It lasts not too long. All right, August 1929, September, October, Irving Fisher says stocks have reached a permanently high plateau. Great Depression. Okay. Federal Reserve does not pump and print too much money into the economy immediately, but they do take action and lower the discount rate. Nonetheless, it doesn't seem to matter. Not all banks, by the way, can borrow from the Federal Reserve. This is a problem according to them. Nonetheless, they lower it and lower it and lower it, and the Great Depression continues on no matter what they do. We'll talk more about this in the future, but this is really all I wanted to show you this video. We can see very familiar patterns, especially for those of you that are familiar with how the raising and lowering of, say, the federal funds target rate or the interest on reserve rate looks. We'll look more at that in future videos, but this was the main policy rate back in the time of the Great Depression and the Roaring 20s. Before the Great Depression, you see a very familiar pattern. Okay, lower interest rates, printing money, higher interest rates, cutting off money, lowering them to recover again. The mistakes that they made before the last boom, and the mistakes of the bust that the bust caused, lowering interest rates and then rising again, causing, trying to cut off the high inflation that lower interest rates caused before that. And then, of course, the Depression again, they have to lower again. So this is a little bit of the history of the Federal Reserve, the discount window, and the Roaring 20s up until the Great Depression. This is how it actually looked. We'll explore more in future videos. Thanks for watching.